David, welcome back to House Street.
Well, thanks for having me, Tom.
Last week you had a headline story that had us going about the change of the silver market, and now comes some changes that I'd like to throw along your way and see what you say. The Financial Times, a disturbing new trend has come up that hedge fund and other investors are increasingly seeking to invest in physical commodities themselves, the silver and gold, rather than in futures. What's your thoughts on that development?
Well, I think it's significant, and it could become more significant. Basically, a little history, and most of our listeners probably already know this, but there was a very large position held by a hedge fund in the GLD, the ETF for gold, one of the bigger ones. And I don't know what influenced them, but we'll just say that some of the more known writers in the sector, probably I'm going to guess Jim Poplava is one from Financial Sense, probably some of the writers on HouseStreet.com, perhaps myself, whatever. This gentleman kind of had a wake-up call and said, you know what, I'm selling my multi-billion-dollar position in the GLD, and I'm moving it into physical gold. That was sort of, I think, the first one out of the gate, so to speak. That means that, you know, others that follow this guy who's had a very good track record and he's into gold is changing the type of gold ownership that he has from an ETF type of gold holding to a physical holding. Why? Well, I can't speak for the man, but for myself, it's very easy. The ETF is fine if you're a trader, you only want price exposure, but one is within the system. And one of the reasons that you want gold and silver is they're the only asset classes outside of the system if you hold them properly. And properly means that you hold them in physical form and you have them stored properly, and now they are outside of the system, which means that if there was a banking problem, for an example, or a trading problem on a futures exchange or with the ETF, or a stock market hiccup, or a trading halt, or any things that are possibilities, doesn't matter to you. You could walk over to your safe deposit box, pull out your gold or silver, and go make a transaction if that was the case. Not that you would, but you could. In other words, it's protected outside of the mainstream financial system, and that's what I stress. So certainly, if you have that portion of your portfolio covered already, and you want to hedge your position or get added exposure and use the ETF to do so, I really don't have a big problem with that. But when you consider the ETF to be or any paper, gold or silver product or precious metals product, to be your primary holding. In other words, you believe that because you have exposure through the stock market for a precious metals investment or an oil investment or some natural resource, and that is your protection, you better rethink it. Because if everybody's thinking the same, nobody's thinking very much. What you have to understand is really you're still exposed to the system, and that's what you're trying to avoid.
This is just let me play devil's advocate. Okay, we know that China and Japan have got around $2 trillion in U.S. denominated funds. We've got the Arab states, $2 trillion, give or take. So all of a sudden they decide to buy, say, all the silver and copper above ground, and instead of deploying it and making cell phones or shipping it off to get it smelted into America and turn into a building, whatever, they sit on it because the shortage has raised the price. So then what follows?
Well, it's a scenario that, possible, obviously, and I'll give you a story, and it's a true one. I won't mention any names, but I have a very good friend in Canada that does a great deal of consulting with fund managers. And some of these guys wield some pretty, capable amounts of money, not as large as we're talking here.
But big.
But big. And so he called me, and this was about 2 years ago, actually, and he said, you know what, they're looking for some really good ideas. Do you have any ideas? And, I didn't really think it through because of the number of, dollars that he gave me. And I said, well, sure, why don't you set up some kind of a silver bank and, buy physical bullion and store it? And he started chuckling, and he says, okay, we just did that. We bought up all the remaining silver in the world. Now we have 90% of our funds left. Now what do we do?
Wow.
So that, I think, is a very important question that you asked, Tom, because, and that's the truth. I mean, you can take it or leave it. It is factual, and it kind of, put me back on my heels from the aspect of, I've always known the silver market is small, and, of course, I knew what it was worth at that time. It just kind of blew by me because certainly silver is a very good asset class, and it's comparable to gold in many ways, but it's a very small market. So anyone that's of that caliber, of that kind of money, to move into the silver market, will it move the price higher? Absolutely. It'd send it to the moon. But they can't get enough exposure to it to really do them any good, if you follow what I'm saying.
I got you.
International banks and nation states like China can move into gold because the gold market is still big enough. It's a small market relative to the stock market or the bond market or the debt markets by far, but still it's big enough that you can get some exposure for protection. But if you wanted to get protection and just use silver as that one entity, for any large-sized capital like we're speaking about, it's impossible. It can't really be done. That's like Warren Buffett. When Buffett bought 20% of the above-ground supply of silver in 1999 and announced it in 2000, he did it in the commodities market because he could only get that kind of exposure through the silver itself. Now, I don't mean to contradict myself. I'm going to make the point here. Because he couldn't have gone into any stock. He couldn't have gone into Pan American or Silver Standard or Western Silver, any of those, because those market caps were so tiny that he would have sent them to the moon. The only way he could get silver exposure was to go into the physical market, and at that not buy like all of it, because it would send the thing to the moon. He did it slowly over time, accumulated his position, and then he announced it. That can't even be done anymore. There's not that much silver left anymore, at least for my work. And
precious metals have been the front page story here in Canada every day, which is no surprise to you because, as you know, and you write to your American and world audience, this is a very mining-centric country. But I'm noticing more and more, and the major publications in the States, it's now being brought up more and more. I actually heard them refer to the price of silver going from 4 to around 17 and change. So it's starting to creep into the consciousness. So that begs the question, when your fellow Americans realize, as you said earlier in this broadcast, wake up to the fact that the dollar's not in very good shape and they're looking at down the barrel of a gun, and then the mania starts and everybody runs to the dealers, what happens next?
Well, that's the euphoria start of the market, and I'm 99% sure that will take place. Of course, the question is when and where are we in the cycle right now. I don't see that really happening now until probably about the 2012 time frame, although obviously everything is set up where it could happen, tomorrow. I don't think that's the case. I think we've got too many deflationary forces and recessionary concerns going forward for the next several months before we really get into the optimistic phase of the market. I mean, and I think we're going to have probably a pretty strong first quarter for the metals, and then we may have to back and fill again. I don't know. Gold actually, and very few really believe it, but gold does pretty good in deflation. In fact, actually does better than in inflation. So gold is the ultimate currency. Silver, as I've said before, has kind of a mixed go at a true deflation. But we're in sort of a deflation of financial assets where the stock market's coming down, but we're in a hyperinflationary mode in the credit system, which is all these loans that have gone through TARP and the Federal Reserve System. But that credit hasn't been turned into money yet, but it's being turned into money because what's happening is most of our major purchasers of the U.S. debt are pretty much fed up, and that's a deliberate pun. Right. They're fed up. And so the only one that's left is for the Fed to come in and monetize the debt, and that is creating a bond or credit in the money. And that money, does eventually work itself into the system. And everyone knows the game. I mean, I'm not seeing anything here that the smartest people on Wall Street and the major banking system doesn't know as well or much better than I. And the problem is they don't have a solution either. I mean, I don't have like a solution. And the last thing they're going to do is give up control. They're not going to say, okay, well, the true price of gold is, 10,000 an ounce. Let's go back on a gold standard tomorrow. They're not going to do that. So it's going to unwind further as far as I can see.